Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
G'day, welcome to the Australian Property Podcast. I'm Pete Wargent. This is our weekly 2 cent segment where we talk about the big three property news stories of the week. I'm joined by Mr. Chris Bates. Chris, how are you?
Mate, Pete, good to see you. Life's good here. How are you doing over there?
Yeah, pretty good. I've been over the past week, just been up in Cairns. First time the kids have been up there, actually. Did the Kuranda Railroad and the cable cars and got out onto the reef. Absolutely fantastic. So can't complain. And I guess the kids took to the snorkeling pretty well. Back to the grindstone this week, though. How about yourself?
I actually went up to the Australian Mortgage Awards on Friday. We didn't actually win the National Broker of the Year. A good friend of mine actually won it, which was good. And then went up to Newcastle to see my mum who lives up there, and had some coffees down Mary at the beach. It's such a good spot up there. So but things have been pretty interesting at work. We've had double figures in terms of number of purchases last week. Month on month, our number of clients buying is really increasing. I mean, it naturally does at this time of year, but it's really there's a real urgency there. If the buyer finds the right property, they don't want to stuff around and they're keen to make offers. I think that's and you can see that. So we've already got very low listings, and then there's enough people enough buyer urgency there, I would say, right now versus what there was even 3 or 4 months ago. So been a busy time. Has your team been buying much, or what's been happening?
Yeah, same. It's really interesting, because if you went back 12 or 15 months ago and you'd have told me the cash rate would be above 4%, I would never have believed the resilience in the market is just wild, but we've been buying more inquiries than we can handle in some cases. And interesting you mentioned Newcastle. It seems to be one of the real popular spots at the moment, Central Coast, Newcastle. We're getting stuff bought as well. So the market has held up way better than I would have expected, everything considered. And I guess, we've talked about some of the reasons for that over recent podcasts, but particularly just the low number of listings. There's just not that many people have sold, and the stock's being absorbed. So it's been pretty interesting. So let's rip into the 3 news stories of the week, shall we? So first one, mortgage monster swallows 1 in 5 households. So that was a piece that came via some research from Chris Joy of Coolabah Capital, saying that basically 1 in 5 borrowers is screwed with debt repayments exceeding their income. So we'll take a bit of a deep dive into that one. Second story, Indian students rush Canada and Australia. So big boom in Indian students. It's one of the big sort of demographic trends at the moment. So we'll have a bit of a look at that. And then also there's a Fin Review article on the investor exodus out of the market. But as we've kind of already touched on, that's a bit of it's a double-edged story. That yes, there are some investors looking to sell, particularly those who are cash flow sensitive. But there's actually more investors coming back now, it seems. So things going in both directions. Not such a clear-cut story on a net basis. Chris, let's start with this story, mortgage monster swallowing 1 in 5 households. So this was covered in Macro Business by Leith Van Onselen. And here's the sort of the tagline. Chris Joy from Coolabah Capital believes 1 in 5 borrowers is screwed with debt repayments exceeding their incomes. So currently 13% of all borrowers have negative cash flows after paying their living costs, things like private health and school fees. And that's up from just 3% of borrowers in 2022. And if the Reserve Bank was to lift the cash rate to 5.1%, then they judged that 17 to 18% of borrowers would have a negative cash flow. So what do you make of all that, Chris?
Look, I mean, Chris Joy's been really successful in, I guess, forecasting the Australian property market over the last, for a long time, to be honest. I would say that he picked, the top and the downs, et cetera, in, previous cycles. In this cycle, he was, very negative coming into, 2022, and he got it right. He said that, once rates start going up, prices are going to fall dramatically. But he said, if rates go up 1%, prices will fall maybe 15 to 25%. But rates went up 4% and they sort of fell 10%. And now, it's likely within a month or two, Australian house prices are going to be higher than what they were at the peak. So we're going to have an all-time high, which is pretty crazy, which is what we spoke about. So, Chris Joy has been doing a lot of commentary around the negative cash flow and, how households are holding up. And, yeah, absolutely. You have to say that debt stress is there, particularly if rates stay high and they stay high for longer, then there's absolutely going to be families that are really struggling. We can't see that in current data, though. We can't see arrears numbers, besides that the non-banks are a little bit higher. Even investors can offload properties. And so if they are struggling, on our book, we've got no arrears. Well, one client, unfortunately, with health issues that the bank's helping anyway. So, yeah, I just don't see this debt problem, cash flow problem, to be something that's just going to all of a sudden turn into this big, thing that'll crash the market, right? Absolutely, you're going to see people, over the next couple of years really struggle if rates stay, where they are or go higher. That doesn't mean they're going to rush to the exit. They're going to use all their buffers. They're going to use any other shares. They'll get access to family. And then you're right, some people will have to sell, but we're selling particularly houses into decade low listing numbers. And when the market's going up, when the market's basically screaming for more properties on the market, so it's not like it's got an oversupply problem, it's got an undersupply problem. Then you've got the building issues and all these rental crisis and that are encouraging people to enter the market. And so, yeah, absolutely, there's people, and you could focus on these numbers and get really excited and go, okay, all these people are going to rush to sell because they've got negative cash flows. It doesn't mean that's what's going to happen. And this fixed rate cliff that everyone's talking about is really just not happening, right? We're not seeing this rush of properties on the market. The final thing I would say is that if the borrower believes that it's only a short-term problem, i.e. they've lost their job, and unemployment staying very low is supporting this, right? Because if unemployment really jumped up, well, your negative cash flow numbers are really running out, and the banks are unlikely to want to support you if, one or both of you aren't working. But even if you're in this situation where, you can't afford your mortgage, doesn't mean you have to sell. You can work with the bank. He'll give you a payment holiday. You can try to ride, and it makes sense to try to not sell right now because you go, well, if I sell 6 to 12 months later when the market's going up, that could be quite a big difference to my sale price. So you'll do everything you can to hold on, knowing that you might not be able to get back in. So, yeah, I think these make great headlines. They make great stories, and the RBA data backs it up. But what does that actually mean for the property market? I would say not too much at the moment.
Yes, it's an interesting thing, isn't it? Well, I suppose that the future is unknown. The Reserve Bank may well not lift the cash rate to 5.1% in line with peers. We may or may not see another hike. That's not clear at this point. Possibly even by the time this goes to air, there'll be more information. But at the moment, anyway, cash rate's not up there. There's also, I guess, there's mortgage buffers in place. Now, the RBA research did show that more than 40% of households have less than 3 months of mortgage buffers in place. But I think like a lot of this stuff is based on, estimates, really. It's estimates of borrowers with cost of living exceeding their income. And it's based on the old, what they call the HEM measure, which you would know better than me, Chris, what that stands for, household expenditure measure. I can't even remember the terminology, but it's these are estimates at a macro level. And look, I guess there's two ways of looking at it. Firstly, when you get problems in housing markets, it's at the margin that makes the difference. It's those people who really are getting into debt stress. But I guess that overall, most borrowers are absolutely fine. So I think the key point, and you have already nailed this, is that if people think that interest rates are going to keep climbing, the property market is going to turn into a bit of a quagmire, then that could become a problem. But that's not really what most households are seeing. They're looking across to the other side, and they're expecting interest rates to start coming down at some point. And I think that, there's been other figures out this week on building activity, and that showed dwelling starts have fallen to decade lows. Dwelling commencements have also plummeted. Also dwelling completions have also plummeted. So the dwelling supply is just not keeping pace. If you actually look at those figures on an annual basis, we're probably building for population growth of about 250,000, but it's running at 3 times that. And households can see this. It's supply and demand. And I think that's what's keeping a lot of people in the market and not leading them to sell.
Yeah, absolutely. We haven't got to that negative news cycle spiral. In fact, it's actually done the opposite, right? House expectations, if you look at the Westpac surveys, really started to change October, November last year, I believe, and people became much more confident around where property prices are going. And then that that has flown through all the way through 2023. I just did an episode with Carlos Cacho, so on the Australian Property Podcast, which will come out in the coming weeks, and we talked a lot about listings and the issues we're seeing with investors exiting the market. So unit supply, apartment supply is really high. So you can't argue and say there's not many listings of apartments. That's definitely the case. But detached housing is at really all-time lows. And then the regions have got different problems. The regions absolutely are starting to see a bit of inventory, a little bit of stock on the market that's building up. And the problem with that is that when people see a lot of things on the market, they go, well, there's no rush. I've got lots of choice. I can be patient. I can be picky. Prices aren't going up. And people are also more likely to sell in that market if they have to, because they're going, well, I better get out now because this isn't going to go well in the future. So whereas if people say, well, actually prices are going back up, maybe I should just hold on. I think there's that positive news cycle. And you can already see that in the media. I think in a couple of months' time, it'll be all over the media that we're at higher house prices than we were pre-rate rises, which will be a bit of a strange story in itself.
Yes, I think if you look at where you mentioned the mortgage cliff, well, as this plays out in full, I think if you look at total mortgage repayments as scheduled, they're going to be basically as high as we've seen any time in recent history. So there's definitely going to be some pain, but I think at this point anyway, it's mostly going to be seen in falling retail expenditure. So people will cut back on costs. I think that's the thing with unemployment staying so low. If you look at historically where mortgage arrears and defaults come from, unemployment mainly. And sometimes if you get extended rental vacancies, then that can become problematic for landlords. But that's just not a factor. The SQM had some figures out for September. Vacancy rates are falling again. They've actually seen in October, they've fallen to the lowest level on record. And Louis Christer of SQM basically said, well, this is just going to continue. The population growth is running at, 650,000. That would just dwelling completions are just nowhere near the pace they need to be at the moment. So, yes, there might be some seasonal relief here and there, but, the rental vacancies just aren't a factor. And also, I think that leads some first-time buyers to decide to buy, I think, or at least try to, because the rental market's so tight. It's so difficult to get quality rentals. And I guess if people are worried about climbing rents, then anyone who can afford to buy is probably going to be looking to do so.
Yeah, one of the strongest things that underpin the house price growth or property price growth is the way that our rental system's structured, right? You can't get a long lease. The quality of properties aren't always available for the type or the size or the location that you want. And so that insecurity around being able to get rentals for what you need as your life changes and get long leases, particularly when kids come along. If that was there, then people wouldn't be forced to buy as much. And I think what the recent rental crisis is highlighting is that, that danger is still there. If anything, it's even worse now because vacancies are really low. So that's making those people who are thinking, oh, maybe I'll just be a rent investor. and I'll just rent where I want to live and invest. Well, maybe that's not as easy as it sounds. You know, people are going, well, maybe I do need to get home security. I do need to make sure I own a home because renting's not easy. You know, rents are going up. There's vacancies. I can get kicked out by the landlord regularly. That's not the life I want. I want to buy. And I think a lot of first-home buyers are seeing that because they experience a rental crisis, not just a housing affordability crisis at the same time. So let's go into story 2, Pete. What are we going to talk about today?
Yeah, so I guess this ties back to what we were just talking about. So population growth at record highs, but a huge part of that really is the return of international students when you look at the composition. And at some point, those international student figures are going to have fully normalised. And I guess following on from that, population growth will actually start to come down towards somewhat more manageable levels. At the moment, it's out of control, 650 or 700,000. But I guess when you actually look at the graph or the chart, well, population growth from migration basically went to zero. In fact, it was negative for a while because we were losing people. The backpackers went home, the working holiday makers went home. We lost a lot of students, but now it's come absolutely roaring back. And interesting, so Justin Fabo at Macquarie Group did some really good analysis on that. And he's shown how from the international student figures, well, let's look at the visa numbers. They were running at up to about 550,000 or thereabouts pre-COVID. Then the student numbers basically halved and a lot of people were working or studying remotely anyway. Now we've come roaring back to record highs, 660,000 in 2023. And if you look at the component parts of that, well, it's the big growth has been in Indian students. So the biggest number of students internationally still comes from China, but the growth in Indian student visas, well, it's over 100,000 now, 29% growth over the year. So that's an interesting one because India, certainly from a permanent migration perspective, has become a more and more important piece of the pie for Australia in recent years. India's now taking over from China, I guess, as a key trading partner, but also in particular a key driver of population growth.
Yeah, I mean, what a population over there is, right? And the amount of wealth in India that's being created on a daily basis, and the strength of the economy and the demographics behind. I mean, I wouldn't say I'm a demographic expert, but I've looked at it before, and it's pretty strong in terms of, I don't know what you call that chart, where that's a bit like a vase. What's that chart, Pete? You can help me here. But I mean, yeah, the demographics.
They do call it a population pyramid, but as you said, very often it's not actually a pyramid shape these days, depending on which country you're looking at. So, I mean, traditionally, people didn't live all that long, but these days, some countries are getting top heavy, people living longer and don't have the births coming through. Australia is very lucky because our population pyramid is very strong in that 20 to 35 age bracket, largely because things like international students, young migrants coming in, and the way we've structured the visa programs.
Yeah, that's right. And the more that young people are working, the more people are working compared to the people that are retired. That dependency ratio is really important. You look at other countries. China's got a problem there. Japan's got a problem there, etc. So, I mean, I guess it's just all about handling migration and, I guess coming into a building crisis. Where we've already got low rental vacancies, but housing affordability crisis, and now I think we've got the next level is a building crisis. It just doesn't make sense for developers to build unless things change, whether it's building prices, whether it's government incentives, or governments put their hand in their pocket and say, I'm not going to collect those taxes anymore and give it back to the builders. Maybe they change zoning. Maybe they allow developers to move from townhouses to apartments. I think suburbs are going to have to shift to make feasibility study, feasibilities work. So, I think the next few years is going to be yes, migration's great for our economy in lots of different ways, right? But, how do we actually handle that from a housing point of view? I mean, it was just back in pre-COVID, we were talking about our infrastructure wasn't keeping up, our roads, our trains, our public infrastructure. But now I would say it's our properties and our supply. And, I think there's going to be a lot of innovation there, whether it's tax or whether it's zoning. There's going to be some things that have to happen. I think that's the real power behind the YIMBY movement at the moment. I think there's a real pressure on zoning changing, not just on the fringes, but also within the inner rings of capital cities where a lot of people would like to live if they could find something.
Absolutely, yes. I think managing the population flows is going to be the big challenge. I've noted over the past year or two, so China used to be the biggest population in the world, but that's now sort of leveled off actually sooner than expected. India is now the biggest population, over 1.5 billion. So there's a huge number of people. It doesn't take a big percentage shift in migration from those countries to really move the dial in a smaller population country like Australia. It's not just Australia they're heading to. There's 800,000 international students studying in Canada. Although I was reading this week that there's some debate about whether the figure might be as high as 1.3 million. But like in Australia, the main driver of the flood of Indian students, well, it's the lure, I guess, of permanent residency. And the big increases in applications in some of the states in Canada. I think, just from a dynamics perspective, in China has really been importing Australia's iron ore and coal and gas and all of our sort of minerals, I guess. India is probably going to be less of a driver for our mining exports. But yes, in terms of residency, it does seem that that's a big driver for people coming over from India, originally as students, but quite often there's going to be pathways there for people to stay. And from a permanent migration perspective, India's already taken over as the top dog, as the source country for permanent migrants to Australia. And there's a lot going on in the background here in terms of Albanese government policy. There's migration agreements been signed with India. There's 5-year student visas for Indian students, and there's no caps on that. So there's a whole load of stuff there that's just making those pathways easier. The challenge, as you said, is that most new arrivals to Australia are going to be renters initially. Mostly they're going to Sydney and Melbourne. And at the moment, as you said, the construction just isn't happening. The ABS figures this week showed that. I was interested to have a look at the number of dwellings under construction, Chris. This has been something that's been a head scratcher over the last year or two. We had a record number of dwellings under construction, about 250,000 or so. That figure's starting to come down. But still, even now, there's still a lot of, at least ostensibly, a lot of dwellings in the pipeline, but they're just not being delivered. And I wonder if that's just a function of the number of insolvencies in the sector. There's another big one went down this week, or went into liquidation in Western Australia. So practically every time we speak, there's another significant building insolvency. So we're just not getting the supply to meet the demand, especially in the rental space.
Yeah, and I think it's a bit unfair to blame the developers. Not saying you are, Pete, but just in general that that developers should be building. Well, they've had it pretty tough the last few years. The rain, labour shortages, material prices. A lot of them are on trying to make a profit, and then their costs went up dramatically, and that their margins are not as big as people think. Their return on equity is decent. The amount they invest and how much money they make on that money, but the margin of their total costs. If things go slightly wrong, that job goes from profitable to unprofitable. And I think a lot of builders haven't been making the profitless boom was sort of the talk of the town over the last few years. And like you're saying, a lot of people haven't been able to stay on. They've insolvencies are at all-time highs in the construction industry. So I really feel for them. And so if I was a developer right now and I've got a piece of land that I could develop, but I'm not going to make a decent and it's hard for me to sell them at the moment, because unless it's for the cashed up downsizer, it's not borrowing, who hasn't got borrowing capacity issues, and really just wants that lock and leave. And if I'm building for the top end, absolutely. You can see in the eastern suburbs of Sydney, people like Fortis are doing, enormous amount of developing. And you go around the premium suburbs of Melbourne, you would see similar, etc. But and the Gold Coast, the Gold Coast, but there's $6 million for a big apartment in Gold Coast, overlooking the water there. So they can sell that stuff. But, the things that suit, particularly first home buyers, they just haven't got the borrowing capacity to make the numbers work. And to be honest, they've got choice anyway. There's already enough apartments on the market that they could buy. So Yeah, it's a really challenging situation. Victoria's put in this vacancy tax to target developers on undeveloped land. I think that's just I don't know. I think that's not necessary, really. When you can, yes, I think if someone's got a piece of land that they've held for 20 years and they're just sitting on it, but developers who have bought in recent years with the idea to develop, then the market shifted. It's hard to then say, right, now you've got to pay all this tax. To watch this space, but I can't see the building industry going ballistic over the next couple of years until borrowing capacity goes back up or prices fall. But both of the, materials and labour and things like that. But knowing, talking to builders in the construction industry, the last thing they want to do is reduce their prices. They were already running on pretty low profit margins coming into this boom. So this is a chance for them to finally, stay ahead.
It's a great misnomer, isn't it? People talk about greedy developers, but it takes about 15 seconds of research to look at the listed companies and see what kind of margins they're operating on, and it ain't good at the moment. Now, construction costs, materials costs seem to have at last leveled out or almost leveled out, but there's still pressures there on wages because it's not just residential construction that's been going like their clappers. It's also infrastructure, transport projects, mining. So it seems unusual to be talking about labour shortages given the rate of population growth and immigration, but that's where we're at. It's hard to see construction really lifting that much until there's more confidence and prices are going up and we've reached the peak of the interest rate cycle. Lots of challenges there. So, Chris, the third and final story this week, investor exodus gathers steam in Melbourne and Sydney. So this is interesting. AFR piece, I think it was Nyla Sweeney put this one out. Low capital gains and a large increase in holding costs are prompting more residential property investors to bail out of inner Melbourne and the Sydney market. Data from CoreLogic shows. Yes, now Melbourne's inner city unit market has been a perennial underperformer, I guess, over the past dozen years. And I guess what this speaks to, Chris, is some of the cash flow sensitive investors selling up. Some people have probably just had enough after poor performance after a long period of time. The portion of investor-owned listings across Melbourne City has ballooned to 60% over the September quarter, up from about 50% or so a year ago. So, I think this kind of makes sense on the one hand, but then I guess pulling in the other direction, we saw the ABS lending figures and, investor lending is now getting close to the 2015 peak. So it's rising again. So we've got some investors selling up, and I guess they'll be selling their worst performers or their sort of most underwhelming properties. But there's actually more investors coming back in as well. So maybe on a net basis, it's not quite such a dramatic story.
I would say there's still a lot of more people leaving than entering. I think Pippa did some research to show that how many investors are actually left the market over the last 12 months, and it's a lot compared to new investors entering. And that's so I think that's one of the reasons for this rental crisis is that there's just less rental properties in the market, and they're not selling usually to new investors. I would say I think they're selling to a lot of first home buyers, but there is a lot of investors out there, but I don't know whether they're buying the apartments in Melbourne. I think up where you are, Pete, a lot of money's flowing to Brisbane because yields are higher, and I think people have realised. I mean, even this week a client was talking about Melbourne apartments, and you just look at it and you go, why would I want to buy there when there hasn't been a strong record, right, of capital growth? I think there's people have been switched on to this high density. I think they've realised now that it's actually not great investments. I've been banging on about it since 2012, talking people away from off the plan, and a lot of people were talking about how great it was to get depreciation. Well, not if you're not getting any price growth, right? So, I think there's some investors happening that. First home buyers that can't afford to buy their home are buying investment properties. So that would go down as investor debt, even though it's really a first home buyer. Now, they're not buying a home, they're buying an investment property. I would say there's also some people who would love to buy a home, but they have already got an investment property. They can't afford to get a home they want. And so they're buying another investment property. So they still haven't got a home. So I think there's a bit of investor action, which is happening because borrowing capacities are really tight. and then they can't afford to get a home, so they're being forced to buy investment properties. But I would say that's not offsetting. So I don't think it's always those investors that have got their house and now they're looking to build an investment portfolio. I think sometimes people are forced there because they can't afford to get into the house or and they're still in the rental market.
I think you're actually right, Chris. The ABS reports the value of investor lending, and yes, it's getting close to the 2015 levels, but that's nearly a decade ago now, and prices are much higher. And so that doesn't necessarily equate to the same number of investors. And as you mentioned, a lot of investors might be looking at different price points, particularly for houses instead of apartments. I think the off the plan point is an interesting one because, as you said, it's now so widely known. The risks of buying off the plan, we know the risks are higher, statistically higher. It's not an opinion. Also, at the moment, who'd be buying off the plan when there's builders going bust? It's been reported in the media every week. There have been insolvencies across the sector. But that in itself is actually going to dampen the housing supply. Now, in the previous cycle, most of those medium and higher density projects got out of the ground, or at least many, I should say, got out of the ground because of investors from overseas. But we've effectively taxed the non-resident investors out of the market with the stamp duty surcharges. It does sort of beg the question, where's the supply going to come from? I've seen a few news stories about build-to-rent projects getting up and running, but at the moment it's only such a small portion of the market that the supply is tight now, and this also suggests that the rental market crisis is not going away. If we've got more investors leaving than coming in, so just to wrap up on the AFR piece, the portion of investor-owned listings also increased across Geelong, Whittlesea, Melton, Bacchus Marsh, Glenora, Casey South. So it's not just an inner city thing. It does seem to be across quite a swathe of Victoria. Some investors have just had enough and they're going to put their money to work elsewhere by the sound of it.
Yeah, and if you're an investor that's got multiple properties, it's really hard to digest paying a big capital gains tax bill, right? So, if you've got this place that hasn't performed that well, but there's a little bit of equity in it, maybe because you put in a deposit or you paid off the mortgage, or it has been a little bit of growth in it. If you sell that property, you can free up a little bit of cash flow, which will be enough to get you through this window, right? Or a bridge to the other side, and to where potentially repayments. You're not going to go and sell your asset that has doubled, and you're going to have to pay a couple $100,000 of capital gains tax. You're like, well, that's my good one. I want to keep that. I don't want to pay capital gains tax. Even though it would give me more cash flow, I'm going to regret that. And particularly now, because that asset's probably performing quite well, because it's probably got the fundamentals right. It's probably still got low listings. It's probably still got really strong owner-occupier demand. And you'd be like, well, if I sell that now, I sell it in 12 months' time, I'm going to regret it. Versus that apartment that's just been never done anything for you. It's been a bit of a thorn in your side. Even if it just gives you a little bit of reprieve for 12 months, that's better than a negative cash flow. It's already losing money for you than losing more money for you. So, I can see that the investors will definitely keep dumping in this stuff, and that's going to really reduce the price growth in a lot of high density, because there's not going to be an undersupply problem. And if there's not price growth, then how are developers going to build? If there is potential price growth, though, which is what's happened in Brisbane apartments prices in recent years, you'll also find that more listings will come because people have been holding on till it makes a profit, and so as soon as it's up on what they paid one day, then they're going to exit. And this is what's happened in Perth, for example. A lot of people have started to sell in places where they've been underwater for 10 years. So and listings will increase because finally people can close those loans down without having to put money in. So good stories this week, Pete. And anything else we need to cover?
No, I think you're right. There's definitely a loss aversion thing there, isn't there? Like if you buy a property for 400,000, people would hate to sell for 395, but if they can sell for 405, suddenly it's a whole different equation. It's probably not very rational, but it does seem to be the way it works. Yeah, and I think the Fin Review piece it cited some examples where, for example, Yarra. Yes, prices are rising for apartments now, but over 5 years they've added just 1%. So there's no capital gains to speak of. And I think if people are getting into the black, they'd probably be looking to offload. I think as well, for Victoria, the land tax threshold's been reduced to just 50k. And there's also a 7.5% levy on short stay properties, and there's the vacant residential land tax. There's a lot of things there that are really saying investors not welcome. And maybe in that context, not that surprising that some people are looking to get out. So yes, it's going to bring some supply onto the market, but it's not going to necessarily help with the rental crisis, which seems to be a story that's going to run and run. So I think that's about it for this week, Chris. What have you got up to? What have you got planned for the week ahead?
Well, on that point, Pete, if I was living in Melbourne and I wanted a house down the Mornington Peninsula, which is a great place to live, and it's very scarce land down there, and over the longer term would do quite well. I think that's the Victorian government basically targeted people with second homes and holiday homes, and there could be a potentially Airbnb cap on days, let alone all these other taxes. And so if you're shopping for a place down there, maybe the next couple of years is a good opportunity. And even the second tier regions, you are seeing listings go up in these locations, and so you're getting much better buying. And those places will come back in vogue again, I guess, once hybrid work, remote work gets more and more embedded. When people get forced out of the capital cities again, they'll make these lifestyle shifts, particularly when there's confidence around rates and the economy and et cetera. So that'll come back at some point. So it's an interesting opportunity, I would say, in these regions starting to build where, counter-cyclical to what's been experienced the last couple of years. This week, Pete, I've got a 4-year-old birthday party on Sunday. I'm actually playing football on Sunday morning, which is a rare treat for me. Just seeing some a friend's had another little baby as well, so that's going to be cute to meet her. So, a little family life going on here. What about yourself, Pete?
Beautiful. Yeah, I'm just recovering from a birthday party, so hopefully got a bit of breathing space between now and the next one. Yeah, I've still got ringing ears from that. So very quiet for me this weekend. Just going to try and catch the Rugby World Cup semi-final. So we'll see how the Poms go. Not holding out much hope, but you never know. Stranger things have happened. So thanks so much, everyone, for tuning in. You can catch me at Pete Wargent Blogspot, my daily blog, or at Pete Wargent on Twitter. And I think by now where you can find Chris at Blusk, or drop us a note in the show notes. So always keen to hear your questions. So if you want to say hello, just do that. So thank you so much for joining, and we'll see you next episode. Cheers, Chris.
Thanks, Pete. Talk to you all soon. Happy Sunday.